Today we will talk about having I bonds in your financial projections. The US government allows you to buy savings bond designed to protect your money from inflation. They are called I bonds. Each person can buy up to $10,000 a year of I bonds. What's interesting about them is that federal income tax is deferred until you cash them in or they mature. No state or local income tax is applied. This is important for people who want to retire in California or other high income tax state. They're tax-free if used for qualified higher education with some income limits applied. If you're retiring soon and looking to add bonds into your portfolio and want to use I bonds for that to save on state taxes, in this video I'll show you how to track them properly and then estimate your income tax when I bonds mature for proper tax planning. We'll use a hypothetical example. The family lives in California and they own I bonds purchased between 2009 and 11, and they recently started to buy these I bonds again. So this table is received from Treasury Direct, and it has columns that are provided by that portal, and we added some information into that. So that's first column is that when the bond was issued. As a maturity date, it's 20 years. It will mature in 2029. The original issue price was $10,000. That's how much family paid for that bond. So far, this bond generated $5,100 in interest, which is not taxed yet. And then, so the actual interest so far have been 2.64% for this bond. And the current value of this bond is $15,000. It will grow, and when at the maturity date in 2029, is going to be $17,423. Now, I bonds, they have variable return rate. So there's a fixed part, and there is also variable return, which depends on inflation. So this value at maturity, it's estimate, which is based on the expected interest rate of these bonds. This is just an estimation. So let's say if we change that and say 4.5, you see that the numbers in this column has changed. We don't know what would be inflation in the future, but we can encode some of our expectations here and estimate how much the bond will be worth it and how much in taxes it will generate for us. All right, so the next thing we need to do is that we would like to aggregate these data by year, because we've been the family has been buying multiple bonds in each year. So we'll select this table, go to Insert and Google Sheets, and click Pivot Table. We'll say that we will enter it somewhere here, this pivot table, and click Create. For rows, we will add maturity date. Where is that? Maturity date, here we go. And then for columns, we will add first issue price. That's how much the family paid for the bonds. I don't know why it's not showing right now. So let's try that again. So columns, add issue price. Interesting. Okay. Should I add it values? It's probably not. It should be in columns. Issue price. Okay. Interesting. Maybe it's not columns. I think I keep forgetting. Okay, we need to use values actually. So for values, we add sum of issue price. Then we will add a sum of current value. This is how much bonds are worth today. And also the last one, we will add value at maturity. So this is how much we expect. We don't know yet, but we estimate the bonds will be worth at that year. All right, so now using this data, we will go into the financial projection tool and add this information. So we'll start with net worth. And the family already has, so I'll just delete that. So the family already has their assets and liabilities added. So we are just adding I bonds here. So we will click and add it as other asset, not as account, not as other asset, because that will give us some advantages. And we call it I bonds 2029. So we'll add them year by year. And the purchase price was $30,000 for that one. The family bought it in 2009. And the current price is $45,599. And for annual appreciation, we will set 3.5%. Again, this is our estimate. We don't know for sure, but we think it's going to be in that range. Annual insurance maintenance is not applicable here for this type of asset because it's a bond. Okay, we click Save. And because we already have some projections created, it asks us if we want to add that into these projections. We click yes, apply that. And you can see that this asset has been added into the portfolio. Now what we are going to do, we will add all these bonds into their asset and liabilities form for this family. All right, so we added all I bonds into assets and liabilities for the family, and we just moved the data from this pivot table into the tool. So we have 2030, 2031, 32, and etc. So all the data is there. Now what we would like to do is we go into the financial projections. And when we add a new asset, it automatically creates a separate life event for that. So now you can see there is own asset I bond 2029, 2030, 2031, 2032. Before we move forward, we would like to do some cleanup here. So what we will go into one of these life events that was created and move the rest of the I bonds into that. So first of all, we will rename that and we'll say I bonds, own asset I bonds. We dropped year. So we will use this life event for all of them, and then we will move in existing other assets, and we'll just select these other I bonds that the family owns, and we click apply. All right, so it's now here in this life event, and now these old life events are empty. We can just delete them. Just a few seconds, and the last one. All right, so now we have a life event, and all I bonds are stored in this life event. Now, what we need to do is that you see that these assets are specified to be here till end of the plan. So what we need to do is set the sell date, right? And we will set the sell date equal to the year. So it's going to be 2029 for this one. Click apply. For this one, we will do 2030. Click apply. 31, the same thing. Just keep doing that. 31, and then 32, and etc. So what we also need to do, there is a sell date, and there is a current price, and there is a purchase date. Okay, so we set the sell date, but now what we need to do, we need to create a corresponding income event for this I bond. So for instance, we go and add income, and it's going to be investment income. We'll click on that, and it's going to be I bonds 2029 payout. For income type, we set investment income, and for investment income type, we need to set interest rate. So here we set the values that will help us estimate the taxes. So the principal value was $30,000, and we expect that the value of 2029 I bond is going to be $52,000 to 69 at the time of the payout. So it's going to be one time, and start date is going to be in 2029 in January. And what's important for I bonds is that we need to set state tax exempt to be true, because we don't pay taxes on these I bonds. So what we will do next is that we will add these payouts for all I bonds, and we set the sell price for all of them. So I'll do that offline. All right, so we added all I bonds payout in the tool, and also set the sell price, sell date for assets in the projection. And now we can see on the right how the payout will change, the cash flow will change given the current schedule. What we did here is just we took the data from Treasury Direct website, calculated value at maturity, aggregated the data, and then moved it into the tool. Now the next thing we're going to do is that we'll go back, and you can see now these own asset I bonds life event appears here, and we can see how it impacts the net forward projections. So a couple of things I wanted to mention, right? Just as a reminder, like when adding I bonds. So first, you would like to add it as a other asset, and then so that you could sell it in the future. It's not possible for the manual accounts. You would like to add it as an asset. And then when maturity date happens, you would like to create an income event and set state tax exempt flag to true for this income event to properly account for taxes. And don't forget to set both principal and pre-tax value process to calculate the tax liability correctly. Now, what we would like to do is understand how I bonds affect actually our net worth. And to make it simple, so here we use a demo account where the family continues working, but I will just turn that off, and you can see that this is, let's say this is their income between 2029 and 2034. And now we can actually look into the tax analytics and see what happens there. So, and we can see that when we turn off assets, own asset I bonds, the taxes go up actually right for that period of time. So why it happens? So sometimes it's not straightforward to explain things because US tax code is extremely complicated. But with our tool, I think you should be able to answer most of these questions. So here, when we don't use I bonds to cover living expenses, specifically this one, you see that in 2030 the cash flow is going to be negative for the family. We need to sell assets in taxable accounts. So when I click on net worth, you see that in 2030 there's assets in taxable, tax deferred, and tax free accounts. And first we liquidate assets in taxable accounts, and they go down over time. So when we don't use I bonds, we sell assets in taxable accounts, we pay capital gain tax on the difference between the portfolio value and cost basis. And turns out in this specific situation is that the tax liability is higher for two reasons, right? First, it could be a low cost basis in the portfolio. And second, we are also paying state income tax. So here, if we don't use I bonds, my state income tax is going to be around $9,000. But if I use I bonds, it's going to be $5,000 only in that year, right? And the same applies for long-term capital gains. So if I don't use that, these values go up. All right, so I hope that was a useful demo. Please let me know if you have any questions or leave comments. See you in the next video. Bye.